Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Yep. Let me share my screen. And just as a note, I know we were off yesterday. Will and I both had kids who needed MRIs done. They're playing sports with knee injuries. But tomorrow, I also have to go do something in the morning, so we won't be able to do the pre-market show tomorrow, but back on Monday. All right, so tomorrow, no pre-market show. For today, we'll go over, if you guys have any questions, if you're just joining us, you can put those questions on the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to come on the show and ask your question live and direct, we also provide a link to Zoom. Click on that link, takes you over to Zoom. When you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera, but then you'll be able, once we let you in, you'll be able to ask your question directly. While we're waiting for questions to queue up, we'll start out with the pre-market report. I'll navigate to a couple other reports to get some insights on the markets. There's a big day yesterday. I think market was up like 3% after Powell was speaking, said that they're gonna slow down the rate of interest rate increases. So big up day yesterday. We'll take a look at some of the things that maybe that happened in the stocks yesterday, and then kind of how November finished, and looking forward, what does history guide us? And I did get a couple questions I'm going to try to see if I could address, and a lot of the questions I get right now has to do with risk management, and the questions, either direct or indirect, have to deal with risk. So I'm going to try to touch up on that and maybe talk a little bit about it. The thing is, about some of these questions, there's never a direct, answer, because it depends, right? It depends on the circumstances, the situation, and sometimes you can't just apply one answer fits all. There are a lot of factors that go into trading and risk and positions and what's going on. But maybe what I'll do is start out just talking about it in general terms. And if somebody wants to come on the show and ask the, question with more specific details, then we'll try to take a look at a situation and see if we could answer something that's much more specific.
We did have a question after you go through the pre-market. I'll ask you.
And by the way, I do want to thank, a lot of people have been sending me very nice emails, thanking us for the show, for the Market Chameleon data and analytics have been helpful. So I do want to say a big thank you, because I get a lot of those emails. I usually, it's internal, so I don't read them back, and I don't talk about them that much, but I feel like I do have to say thank you for like a lot of very nice, kind emails people have been sending me. Sometimes it's not just question, I don't only get questions. Sometimes just people send nice emails to us, wishing us happy holidays, thanks for the Market Chameleon, thanks for, coming, doing the show and talking about it. So big thank you to you guys. Because of you, that's what's the driving factor behind the Market Chameleon. So just wanted to say that. let's start with the pre-market report, Will, and then I'll take the question. You said you have an outstanding question.
Yeah.
Okay. So pre-market report. These are stocks trading in the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I have 87 stocks here showing up on our percentage gainers list, 61 on the decliners. From this perspective, it looks like a slightly more bullish bias at the open. We're going to take this list and filter it down to only S&P 500 companies to see what's going on there. And to do that, I'm going to use the filters above. This one in ETF. I'm going to drop it down. What this filter does is give us a list of ETFs. When you select one of these ETFs, the report below will get filtered by the stocks that are holdings in that ETF. So SPY, S&P 500 ETF, let's select that. When you do that, the list below gets filtered by the stocks that are in the SPY ETF, which are the S&P 500 constituents. And here we see pretty much even 4 stocks made our percentage gainers list, 4 in the decliners. So kind of tame, neutral at the open. Let me then, nothing is standing out really right now. I mean, a couple things maybe that are developing that you see is that some of these social media companies are starting to have issues with the Apple Store, actually. Like Apple controls that app, the apps that you could download and have on your phone, and there's a lot of I would say right now conflict between some companies that rely on having their app on there, and obviously like Twitter, we see Elon Musk right now complaining, Mark Zuckerberg, Spotify, and I've heard other complaints where they're basically saying that Apple has too much control, too much power over these apps, and a lot of these businesses rely on having their app on the Apple Store and on the iPhone. We'll see how that's developing, but you do start, you're starting to hear a lot more noise around that.
Well, certainly Musk yelling about it on Twitter. He had a meeting with Cook yesterday at the Apple headquarters.
Yeah.
So he got invited. I mean, developers, smaller developers have been complaining about it for years.
For a long time. And now the bigger, right? So the more people with more influence, bigger voice, are starting to complain about it. And, they're really, you have Apple and Google, right? That control most of that market, which apps can get put on that mobile device. And we'll see if then regulators and law gets involved in that, right?
They do take quite a toll. I mean, I think Apple takes 30% of any fee collect in an app purchase. Yeah,
that's right. Apple makes 30% off the app purchase. It's a big source of revenue. They control other aspects of it, and we'll see how that develops. But definitely, as you're starting to hear that issue's starting to surface up. But let's take let me take the question first.
All right, it's from one of the most active chameleons. Rob is asking, would Dimitri please explain how credit spreads make money again, and if we can see the smart money trades on those spreads in the MC platform? If it's something you want to hold off till Monday, you could do that too. You could,
okay,
but it's up to you.
Okay. So he's talking about like credit vertical spreads. I'm assuming that's what it is. Credit spreads.
He said calendar spreads.
Calendar spread. Well, actually, I'm going to be doing a webinar on calendar spreads with Interactive Brokers. So if you could wait for that, that's going to be coming up not this next Tuesday, but the following Tuesday, and it's going to be on calendar spreads. I'm going to do
All
a
right.
whole webinar on it anyway. For now, just focus on that.
So you'll also talk about, he asks about the smart money trades on those spreads on the MC platform.
So with the calendar spreads, you would have to look them. I'll try to cover, since you brought it up, I'll try to cover. I'll try to, I'm still working on the slides for the webinar, so I'll try to include that in there. Okay.
All right. And I will put that webinar in the chat since you were so nice enough to mention it. And I don't know if you and Rob talked and you placed this in the show this morning, but I will put that in the chat, the link to the registration.
Yeah, that's a good question. Thanks for the question. But since I already am preparing that webinar for the following Tuesday, I'm going to just try to cover, because that's going to be like an hour-long webinar, with questions.
And that is December 13th at 2 p.m. calendar spreads.
Yep.
All right.
I do have a question. It was regarding risk management, and I'll try to talk about it, because there's no obviously there's no one clear answer how to manage risk. There's no Biden or some linear type of solution for managing risk. But I'm going to try to, talk about some of it going forward. But before we do that, let's just take a look at how November ended. So we just ended November in the market. We could see here, this is SPY for the current November, up 5.6%. And a lot of that was also half of it was yesterday alone, or even more than half of it. And we could see that November is historically a very strong month. Over 90% of the historical observations in the month of November, stock market was up. We talked about it in the beginning of November. We could even see that the median return, November 3%, which is the highest out of any calendar month here. Maybe, February comes close. So November, very strong, tended to be a very strong month. December, since we're started December, take a look. 70% of the historical observations, December tended also to be to the upside. The average return's not as big. So we had some big down moves in December, one here in 2018. The median return, 1.1%. So you could see here that November, 3 times the December median return. Also, if we take a look at max positive move, so far up 4.3%, which, is, if we compare it to the other ones, not as high, as some of these other months, but tended to be, in any case, stronger in general for the market. Okay. The one that's coming up, January, that's probably now, that's the weakest month. So November, December kind of finishes strong. January on the weaker side. That's besides September, that's the next second weakest calendar month out of the year. Another thing, since we're talking about calendar spreads, let's take a look at that really quickly. I'm going to take a look at the seasonality of the implied vols. And this is how the implied volatility is seasonally. So this is taking, since 2014, the average implied volatility, how it moves seasonally. And this one, because we're taking an average, March definitely spiked up because of that COVID. So that is taking this average up a lot. But if we take a look at the median, we could see here implied vols, from October declined December and October stayed the same, but then it starts to tick up January, February, implied vols start to tick up. So, calendar spread looking for December to tick down, spreading off, maybe even buying out further, selling near. If you're doing a long calendar spread, and using these historical stats as your guidance, buying out in March, versus some December, buying out in February versus some December would be a potential setup, based on a seasonal target. Okay. But I will try to cover that more on that, webinar coming up with interactive brokers. Let me talk about a little bit about risk. And somebody actually asked me, one of the nice emails that I get, Dimitri, put up your notepad. I like to look at the notepad and just see things written out. And we talk about, what the four elements of trading, education, research, risk management, and execution. And I do get some questions. People ask me, well, especially novice traders or somebody just, get opening up an account. How do I make money? That's a question that comes up. Just tell me how to make money. And to a lot of people, that might seem like a reasonable question. Well, just tell me, this is the stock market. Stock market's about making money. So tell me how do I make money? And the key thing there is, in that question is make, right? Make implies that you have to be doing something. It's not just given to you, but that you need to be doing something to get it. It's not just like you don't get profits for doing nothing, just for showing up. It's like, do you deserve to just get profits for doing nothing? And the why that question is weird is if I ask the question, if I showed up, at a football stadium and said, well, how do I win the Super Bowl? That would be a weird question to ask, right? Because all I'm interested in is in the reward. Just tell me, how do I get the reward without doing much? Or how do I win this chess championship? Or how do I win? How do and the question shouldn't be start from there. It's how can I become a good trader, right? Because that's what you can control. How do I become a good trader? And a good trader will then figure out how to be profitable. So your question should be, how do I become a good trader? Because how do I make money is, a lot of people are implying, just give me a list of stocks, that are going to be up 100% tomorrow so I could buy them today. And that's not how it works. So really it's, how do I become a good trader? And a good trader, in my eyes, it's not the other thing people get confused about. It's about being right and wrong. And that's how they look at it, is I'm going to be either right about a certain outcome or wrong about a certain outcome. And I don't look at it that way. I look at it as a good trader is somebody who's efficient. Okay. You cannot just be right or wrong. You got to be an efficient trader. And if you're not efficient, it doesn't matter if you're going to be even if you're right, you're going to end up losing. So let me show you an example really quickly about, because a lot of people, concentrate on this. I have to be right or wrong. And a good trader will know how to position themselves and set it up that even if they're wrong about the outlook on the trade, they might be looking at a break even or potentially still have enough cushion that the trade itself will be profitable. Okay, that's a more efficient trader. And I'll show you an example really quickly because, spreads come up and why we do spreads, and I'll get more into it. I have limited time, but these are option block trades. A lot of people go to these option block trades to find ideas, right? And the very beginner will look at just to buy a call or buy a put, right? That's the easiest thing, and they think, well, it's because it's easy, that's what I concentrate on. But that's not efficient, and that's really not, that may be the easiest thing to execute. It's not the easiest way or the best setup that you could do to become profitable. And let me just show you about how you could be right. You could be right in calling an outlook, right, by chance, but be very wrong in your trade setup. And let's do a simple one. Let's just say here's an option. I'm going to pick up a call. And by the way, I'm going to show you where, keep in mind, these are not even, these are block trades. Okay. So these are trades that we would consider, not a small retail person doing. If we looked at the small retail trades, they're going to even appear much worse. So these are already people who have more knowledge and are putting up more money per trade. But let's look at a call option. Okay, in the list below here, we have stats on these block trades, the time, the purchase price, and we keep track of what happened afterwards. All right, and I'm going to filter out and show you how people could be buying calls or buying puts. The stock goes up, but they lose if they buy calls. Buy puts, the stock goes down and they lose. And it's because there's an inefficiency going on there, and that actually is more important than being, always right or wrong, because by chance you're not going to always be right or wrong. You're going to have a forecasting model, valuation model that you're tweaking, but it's the efficiency in the trade setup. So let me show you buying a call. So let's say somebody bought a call yesterday on the ask, just bought a call on the asking price, or even paid above it, had to sweep. Okay, and the trade condition will be either auto execution, intermarket sweep, or regular. So somebody bought a call yesterday, and we could see here's one, SPY December 16th, 413 call. Somebody bought this call, right, at 497. So you can see here, 497, they bought the call. The stock price at the time was 407.84. Okay, so this is what we're looking at. Somebody bought the call. We track the price that they bought it, and we track the price of the stock at the time they bought it, and then we keep following that trade to see how that turned out, what happened to the stock afterwards, and what happened to the option. And that's here in the price performance tab. So just to make things faster and easier, I'm going to go here to the performance, and I'm going to say, show me yesterday the stock was up. Okay, so it was up after the trade. So wherever the stock was at the point of the trade, afterwards it went up by at least 0.5% or more. Okay, so you can see here, this stock was in this Visa $215.42, and then the stock went up to 217. So obviously this call should have made money, and the return, so the stock was up 0.7%. And to make things faster, I'm going to show you where the option itself was down. So here we go. BYC. And mind, this is just yesterday. If I go back further, you're going to see much more. You can see a huge list. All right. So BYC, December 15th call, December 15th strike call, stock was 28.78. Okay. At the time that this traded, somebody bought this option for $19.40, right? So then the stock went from 28.78 to 28.96. It was up 0.6%. So you buy a call, the stock goes up. So your outlook, you're right in your outlook, right? You bought a call and the stock went up. So you're right in that direction. But the option itself lost 13%. So the option itself didn't go up because it was just not an efficient trade. You just basically did a trade that was either so ridiculously priced from the start, or you gave up so much edge that even when you're right, you're wrong. And how do you make, so how in the long term can you expect, right? Because imagine if you were wrong, not only did you lose and the outlook was correct, imagine how much you would have lost if your outlook was incorrect. So by being inefficient, and this is probably 99% of the people out there that start out, you're almost guaranteeing yourself in the long term that there's no potential way for you to be successful and to turn it into a profitable process. Okay. And you could see here Tesla. Let's take a look at that one. Here's Tesla. Yesterday, the 200 call stock was 191.66, and somebody bought these. Oh, sorry, over here. Somebody bought these for $63. Did a sweep, paid even over the asking price. So just think about that. The stock went from 191.66 to 194.70, up 1.6%. So, $3 higher. The stock went up $3 higher. And look where you're at. Look where you're at, down 5% on your option. So when we talk about, and this is a very simple way I'm showing you, which is not efficient, right? This is the most simplest way, but because it's just easy to show. But there are other ways when you're not using your strategy setups, when the best thing you should have been doing for your outlook, once you do the analysis, might have been a call spread or calendar spread or a butterfly or whatever it is. But there is a much better setup that just think about the person on the other side of this, right? That the setup you should be looking is, even if I'm wrong, this is a good trade that I still have a break even, or I could potentially make money. Because the better side of this trade would have been this one. Because even though he was wrong, it was still profitable, right? So think about it. It's not about right or wrong. It's about the trade setup and how efficient your trading is. And that starts, not. So when we talk about risk management, there are two parts to risk management, what I wrote down. There's a pre-trade and then a post-trade. And the pre-trade is, as important, maybe even more important than the post-trade. Because if you're doing a lot of bad pre-trade, then your post-trade risk management is not going to help you at all, right? So you got to start with your pre-trade risk management. And that's kind of like, that's what I'm going to start going over. Okay, so the pre-trade risk management of being efficient prior to execution is more important, okay, way more important from the post-trade, because once you're doing inefficient trades, you cannot manage your way out of it post-trade. All right, so we'll talk about that. It's 9:30 tomorrow. I gotta remember, we can't do the show tomorrow. We're going to continue it on Monday.
All right, so Monday we'll continue this. Tuesday we'll also have a morning show, and then we have our 2 p.m. interactive broker webinar, which I put a link in the chat. You can register. Thanks for Rob.
And Will, that's not next Tuesday, the following Tuesday.
Oh, it's Tuesday the 13th. Sorry about that.
The 13th. The 13th. Yeah.
It's 2 Tuesdays away.
Two
All right.
Tuesdays away. 2 Tuesdays away. All right.
Sorry about that. Great job, Dima.
Yep. Everyone, thank you for joining. Stay safe out there. Have a great trading day and hope to see you guys on Monday.
Great. Thanks, D. Thanks, everyone. Have